All right, now before we dive into the trading plans, which I want to introduce after this video, I want to go over the universal agreements. Now, what are universal agreements? Universal agreements are the rules, the set of rules in trading plans that are very similar to each trading plan. So for example, universal agreements right here is risk management and trading time right there. So risk management is one rule and a set of rules that always comes back to different trading plans. So they are all the same in different trading plans. So I thought it would be easier to just make one video on it instead of going over it in every single video of the trading plans, whilst it's mainly all the same. Generally speaking, it's all the same unless I specifically mention it in the trading plan video as well. So here we have risk management and the second one is trading time right there. Now, let's dive into the first one. The first one is, again, risk management. So the universal agreements right here is risk percentage, take profit, stop loss, and break even when we're talking about risk management. Risk percentage, I have gone over different types of risk percentages you can use as well in the past enrollments. I want to go over a different one this time around. Now, one that I like to use is the 5% boundaries. And what I've written down below it as well before I start explaining the 5% boundaries is when upping your risk the same twice. So what does that mean, the 5% boundaries? So here we see the start of a 5% boundary risk management approach. That's quite a mouthful. So let me explain what this actually is. On the left side right here, we see the balance right there. In the middle, we see the risk. So the risk percentage we are going to use in the next trade. Then we see the boundaries that we have right there. So we have a boundary of 5% going either in drawdown and also to our profit. So we have 5% going either side. So that leads us to 9,500 if our starting balance is 10,000 right there, because that's 5% in drawdown. And then we have 10,500, which is also 5% in profit right there. Now the risk percentage can also be lower, can also be higher. If you're, for example, in a challenge, in a funded challenge, and you want to risk more, you don't want to waste a lot of time passing that challenge, you can up this risk percentage to 2% right there. Again, the overall boundary and the balance right there, it stays the same, right? So the boundary stays the same. The only thing that changes is the risk percentage right there and how fast you will approach a certain boundary. Now, how does this actually work? When we now want to risk 1% on the next trade, and let's say we lose this trade, okay, we go into drawdown right there. The next trade, we still want to risk 1% because we're within those boundaries of 9,500 and 10,500 right there. So when we keep on losing and we keep on losing, and to, let's say we have a big loss, we risked 1%, but our stop loss was all the way at, I don't know, minus 5%, something like that. And we lose right here 5%. Our risk on the next coming trade is now going to be 0.5%. So the 5% boundaries right there, they are there essentially to now change your potential risk. So when we hit our drawdown boundary of 5% right there, we want to now drop into 0.5% on the next trade. We want to use that risk percentage until we again climb back into the 9,500 right there. So that is going to be our focus, to hit that 9,500 target right there. And when we hit that, and let's say we win right here with a 1 to 2, and we climb back towards that 9,500, then the next risk percentage is going to again be 1% because we're within those boundaries again. And when we're within those boundaries, and the first time we now up our risk, so that is the rule, when you up your risk percentage, you want to use the same percentage twice. So here, if I now lose this trade, for example, and we go back towards 9,400, then I am not going to drop back towards 0.5% because I want to use the same risk twice. Otherwise, that might create a break-even cycle where if I now lose and I win again with the 0.5%, and I lose and I win and I lose and I win and I'm at 50% win rate, then I'm going to be in a break-even cycle. That's something we want to avoid. The way we avoid that is by using the same risk twice when we are upping our risk right there. So here we want to again use 1%. And if we lose again, perfect, then we drop our risk to 0.5% right there. Now let's say we win right there. Then what we do is, again, let's say we win this trade and we go towards 9,700 right there. And we climb all the way higher, higher, higher. And eventually we might reach the 10,500 boundary right there. Once we reach the 10,500 boundary, let's do 10,600 right there. We move the previous boundary right now towards the 10,500. So this is, the next part is to protect our profit. So let's say we have reached the 10,500 boundary, we are over it. And now we want to move our boundary, what we had at 9,500 to 10,500. So what that means is when we now start losing right here, and we again can keep the same risk management, we can keep the same 1% right there. When we now start to lose and we crawl back below that 10,500 and we lose again right there and we crawl back below it, then right here at this moment in time, when we are back below 10,500, we want to start using 0.5% right there again. And then instead of it being the 9,500, we now want to focus on protecting this profits, right? So we want to climb back above that 10,500. That's our new 9,500 boundary right there. Now, when we then again climb back above it slowly, then here we can again risk 1%. And the same rule applies. When upping your risk the same amount twice. You can get very creative with the amount you're risking. You can even add another boundary if you want to at 10,000. Now, I would advise start off with this. If you use this rule set, then even in a funded account is going to be quite hard, quite difficult if you focus on high probability conditions to blow an account. Then eventually in a live account, you want to use these boundaries, if you want to make more profit, to use the higher boundaries in your profit target to apply and to scale up slowly. So what that means is your next boundary right here can potentially be, okay, now I'm going to focus on 11,000 right there. And when I hit that 11,000, again, I use the same thing. So here, once I hit 11,000, I'm going to move that new boundary, and that's going to be my new boundary. When I hit that, I'm going to drop back towards 0.5% risk. So the same what we did with 10,500. So let's go over one more example right here just to fully clear it up. And let's use the more target orientated example right here, because I think the drawdown is quite clear. Now, if we win, and let's say we are using 1% risk right here. We are winning, and overall next trade right there, also 1% risk. Perfect. We win again. All right, perfect. Next trade again, 1% risk. Perfect. We win again right there. Okay, now we need to be a little bit aware that we have reached a certain boundary. That new boundary is now going to change because now we have 10,500 and we have 11,000 right there. So 10,500 is our lower boundary right now. If we hit that 10,500 and we come back below it, we want to risk 0.5%. If we hit 11,000, then again, we do the same thing. And so let's do that. Let's say we win again. Okay, perfect. We just win. We keep on winning right there. Perfectly fine. And we win again. Wow, perfect. Right there. Now, once we win again, the risk percentage, we overall risk can stay the same, right? Can stay the same. You can, of course, do this as well with 2% risk if you want to, even with 0.5% risk. That is all what you want to do, and eventually you can up your risk even. Now, right here, when we're at 11,000, this now, the boundary again, changes. So the next trade that we risk again is just 1%, but the boundary changes. So now the lower boundary is again 11,000 right there. And the new boundary can again be 11,500 right there, where we would do the exact same thing. So if we drop back below right here and we lose the next trade and we drop back below 11,000, we now want to risk 0.5% until we are back at 11,000 again. And then when we are back at 11,000, we increase our risk to 1%, and we want to again risk the same amount twice. This is again purely to protect the profits. And when we do go into drawdown, we don't want to have too heavy of a drawdown right there. So use the 5% boundaries right there. So now we know how much risk percentage we potentially want to use. Again, if you find yourself more resonating with other risk management approaches that we used in different enrollments, then you can also go with those, right? So it all is about find which one resonates with you. Then take profit right here. Take profit as a general rule of thumb is also universal. So mainly you're going to focus on 1 to 2 RR right there. And if it's outside of context, look at no resistance right there. In the beginning, I would advise focus on 1 to 2 RR. Eventually, you can potentially even scale it up to 1 to 3 RR, seeing what the data tells you, seeing what you prefer as well. But if you're just starting out, I would advise focus on 1 to 2 RR. Now, right here, I want to go over this one, because if that 1 to 2 RR is outside of context, then of course, we need to understand what we want to do. So let's say right here on the 4 hour, we have this 4 hour fair value area, mainly the fair value gap right there that we're trading back into. And on the 1 hour, we are using this 1 hour sharp turn entry right there to potentially get involved. Perfect. Now, the 1 to 2 right here is outside of the context, because on the 4 hour, we had this context low right here that we can target. Okay, now do we cut trade off right there at the context area? You don't have to. If the target is still, the 1 to 2 RR is still within the no re area. So the no re area, you can potentially see this line right now. What is that line? That line is daily swing low. Okay, then next, we don't have any resistance between these swing lows right there and these swing lows. So that we can confidently say that if it wants to continue lower, it's most likely also going to reach this low right there. So the target is in a no re area. Again, ideally, of course, the 1 to 2 RR is inside context. If this is not the case, then pay attention to the no resistance area. And if it's in the 1 to 2 RR, still in a no resistance area, that's also perfectly fine to target that 1 to 2 RR. But let's take the example right here on Euro US dollar. If we want to continue lower, we potentially have this 4 hour gap right there, which also has this context low right there. Now, after that, we have this line right there. That line is a higher time frame fair value gap. So when I look at no resistance, I mainly look at, again, the higher time frame, 4 hour, daily, weekly, and monthly. And right here, we have that fair value gap sitting right there, which could act as a next resistance area. So here, if we now take, let's say, let's just imagine some kind of entry. Let's say the entry was very low and we covered that high right there. And now we want to target a 1 to 2. Then to target that 1 to 2, we are running into that resistance right there. So this would already worry me a little bit if I do want to take the trade. And if I do take the trade right here, I want to maybe have my target a little bit closer instead of a 1 to 2 right there. And I definitely want to go break even a lot earlier as well. So that is personally how I would want to approach it right there. Take into account the resistance areas that we have after the context if you are still targeting a 1 to 2. It's a lower probability always if the 1 to 2 is outside of the context area. Next in risk management, we have our stop loss placement. So where price has no reason to return. On candle science trading plans, that's going to be based on the 2 candle rejection mainly. So what do the next candles need to do if it wants to actually continue higher or continue lower? With order flow, that's going to be based on order flow lags. So for an ST plus RE, it's going to mainly be based on order flow lags. Here on Australian dollar, US dollar, we have this 4 hour value gap, this 4 hour fair value area as well, where we can continue lower from. We see on the 4 hour, the first candle does not reject right there. It's an up candle. The second candle sweeps the previous candle high right there, then eventually rejects. So if you were to enter off of that candle right there, then with a 2 candle rejection entry based on candle signs, your stop loss, your original stop loss is going to be above the rejection right there. Now, if you were to enter on the next candle right there, then you can just follow along with the candle highs as well. But keep in mind, when we then start to create a fair value gap going lower, of course, we don't want to have our fair value, our stop loss above an expansion phase candle or above the third candle high. because then we might sting into a fair value gap. So to give you an example, we don't want to have our stop loss above a third candle high right there when we have a fair value gap created, because then of course we can sting into it to then continue lower as well. So take that into account. But as a general rule of thumb, for 2 candle rejection, your stop loss, your initial stop loss is going to be above the rejection high. Now, staying with Australian dollar, US dollar right here, if we again look at the fair value area on the 4 hour and we dive into the 5 minute to look at our order flow entry, then based on order flow right here, the way we would place our stop loss is we have our sharp turn sitting right there. We of course wait for our re as well, and the re happens right there as well. Now let's say we entered this. When we enter this, as a general rule of thumb, you can place your stop loss above the re lag right there as well, because the re lag mitigates the overall sharp turn and then continues lower as well with a new order flow lag. So with an order flow entry, if it's a re-entry, place your stop loss above the re lag high or low. If it's a ST entry, then for example on the 50 minute, place your stop loss above the ST high right there instead. Now right here we are on US dollar JPY, and I want to give you one more example. Because with an order flow entry, you can oftentimes, and same for candle signs as well, 2 candle rejection, you can oftentimes refine your entry a little bit. But what I mean with that is we have this fair value gap right there. That fair value gap on the lower time frame is of course a sweep of swing lows right there. Based on the trap analogy, we also understand right now that if we get that ST and we get a re right there, then we can refine our stop loss already towards not necessarily this swing low, but even a little bit higher right there, because we know we should not come back below this low right here if we are truly trapping traders at the bottom right there. So breakout trade at the bottom. So based on that, we can already refine it. And here I would argue we can refine it even towards these bodies, where once you get the more advanced understanding, the previous 2 examples based on 2 candle rejection and based on order flow, those are more beginner examples. So beginner friendly when you're just starting out. Once you get the more advanced understanding, you can start to refine your stop loss to areas where you wouldn't even want to see a retracement towards. So for example, I don't want to see a retracement towards these lows of those bodies right there. And if that does happen, then I don't even want to be involved, because that's where the low probability conditions for me start to kick in. So that's exactly where I can also place my stop loss. A little bit more refined. It does help right here. Instead of having your stop loss right there, those bodies, because your 1 to 2 is then also a little bit earlier, and it might just save you from a break even in the future as well. And the more advanced example for 2 candle rejection right here would be, let's say we have the same entry right there on Australian dollar, US dollar right there based on that candle rejection. And instead of covering the rejection, we can cover actually the high that we sweep right there. So of course, this is the example that we use where the first candle is not a rejection, the second candle is a rejection right there. Where we can say, okay, we can cover the first candle high right there, because that's actually a high that we are sweeping, swing high on the lower time frame, where breakout traders are getting trapped. So we can refine that stop loss even more. Again, this is more advanced. So if you're just starting out, I would advise go with the beginner friendly option by just covering the overall rejections and order flow lags for order flow as well. Then after all those 3 components, of course, when we are actually in the trade, how do we go break even and how do we manage our trade when we're in the trade? Now, again, it's the same thing as your initial stop loss, where price has no reason to return, but now you just follow through. So candle signs, it's again the 2 candle rejection. Order flow, it's again the order flow lag as well. First, I'm going to show you again the beginner friendly, after we'll go into the more advanced as well. Now, if we take a look at GBP US dollar, for example, then right here we see this 4 hour fair value gap right there, where we can potentially continue lower from. First candle does not reject. Perfect. Second candle does reject. So let's say this was the entry right there. Let's say this beginner friendly option as well. That right there was our stop loss, initial stop loss. After we start to continue lower right here, we can already go break even quite early. So as soon, the focus with a 2 candle rejection is always after the 2 candle rejection, create a new fair value gap as soon as possible. That is the objective of price right here if it wants to continue lower. So here, As soon as we have a new expansion going lower right there, happening at that moment in time, we can already go break even. So right now we have 34 minutes left until we create this expansion going lower right there. I would not want to see price retrace all the way back towards those highs right there to then continue lower. So here, this can already be a break even right there. Oftentimes, you can find as well for yourself, you can go break even earlier than you think. And break even is again the same as a stop loss, initial stop loss, where it's placed at areas where you do not expect a retracement towards. So ask yourselves, right here, if I was to actually look for an entry, would I be interested in a new entry if it was to retrace all the way back towards those highs right there? Probably not, right? So that means if that's not the case, then I would expect price to already continue lower and not make a huge retracement. And if it does make a huge retracement, which it definitely can, and that means there's a low probability and I should not be in that trade. So I should just get out as well. That's very important to understand. Here we are with the same example on US dollar JPY. So we again, to remind ourselves, we have that daily fair value gap right there, which we are sticking into. Let's say we have an entry on the 15-minute right here with a 15-minute ST plus RE. Let's say we entered off that first fair value gap right there. We covered this low right there. Now, you can go break even based on order flow as soon as price has no reason to return. So what does that mean? You have to take into account a few things. When we create a new order flow leg right here on the same time frame, perfect. That's already when price has no reason to return based on the 15-minute time frame. But we also need to take into account right here the 1 hour time frame right there. So the 1 hour time frame is of course the time frame above us. And if there's a fair value gap still, which we can trade back into above us, then we should take that into account as well. So right here, if we go again for that same entry right there, and we enter off that fair value gap, then right there, as soon as we start to continue higher, and here we also start to continue higher and actually start to create breakaway gaps right there. This is a breakaway gap right there. To continue higher, get very close towards the context high. And at that moment in time, I would argue you can already go break even right there. And when you get taken out break even, either potentially look to re-enter again if it is quite clean. But this right here is where I would already, this right there is where I would already go break even because I'm expecting price to just continue higher, not make a huge retracement like this right there. Expecting price to already continue higher towards the target as well. So right here on YM, we again have that 1 hour fair value gap, which we can potentially continue lower from right there. So I wanted to more so go into a live example right here as well. Then how we go break even right now based on order flow. So on the 5-minute, do we have a sharp turn entry before we reach context lows? We do not. Okay, perfect. Let's dive into the 1 minute actually. On the 1 minute, what do we see? We have our sharp turn right there, and after our sharp turn we have this beautiful re-entry right there as well. We can even cover the bodies right there. I'm not expecting a retracement towards all the way towards those highs. I'm only expecting a retracement in worst case scenario towards these order blocks right there that we have to then continue lower off that fair value area. So here, as soon as we continue lower and we start to continue lower, we start to take out all the resistance as well, then we can again go break even quite early. As soon as we create a fair value gap right here, then based on order flow, we have now created a new 1 minute order flow leg lower right there. And when we create that new 1 minute order flow leg lower, and our entry was quite high in that order flow leg, then if I were to place a new entry right here, would I like to see price retrace all the way back towards that exact high of that order block to then continue lower? It's very unlikely. And if that does happen, then most likely it's going to be low probability conditions and we might not actually want to continue lower. So that right there, for me, instead of placing it at that exact high, you can already go break even right there because price simply said has no reason, no logical reason anymore to return right there. So that can again be break even quite early on. Now, a more advanced option is combining order flow with candle signs. So this is mainly regarding as well, if you're taking an order flow entry, you can potentially look at it as well through a candle signs lens. Now, at first, I would advise if you are just starting out, stick to the options we just went over as well, the more beginner friendly options. Because if you try to be too strict with your break-even rules as well, then you are going to most likely take a lot of break-evens, and you're going to just be in that break-even cycle where you take so many break-evens that you're not letting your trade run anymore. And when you do find yourself in that scenario where you take a lot of break-evens, which are missed winners instead of prevented losses based on your data, then open up a little bit more with your break-even. So be a little bit more loose with your break-even if you do notice that. Now, right here on US dollar, Canadian dollar, we take this random 4-hour value gap, and just trying to show you the example right there. We have this fair value area right there, which we can potentially continue higher from. Then right here on the 5-minute, what do we see? We have this 5-minute sharp turn right here. Then let's say, just for the example's sake, if a sharp turn was our entry and our initial stop loss was below the lows right there, when can we go break even? As a general rule of thumb, when we create the re right there, and the re has a new move higher as well off that as well. So we have one order flag higher, a new order flag higher right there, then we can go break even. So as soon as we see this fair value gap right here, we can again go break even. Now, if we were to use candle signs based on this ST plus re-entry right here, then again, what we can see is that we can go break even before a new fair value gap. So if you're truly using candle signs right there to go break even, and you were to use this entry and you were to use the 2 candle rejection, then you could already go break even as soon as we start rejecting right here. Then this could have already been a break even right there, or even cover at least this low right here. But again, you can also see that we eventually come back towards that break even level to then instead continue higher. So if you're just starting out, I would advise go for the more beginner friendly option. Where candle signs as well, if we are looking at a more advanced option, we can go break even when we have an expansion phase candle like that. When we create an expansion phase candle like this, we should already think, hey, this should now create actually a fair value gap. So if this is going to create a fair value gap, it's likely not going to trace very far. It's going to retrace towards those fair value areas, potentially, worst case scenario, to then continue higher. So when we take a trade like this, then this in itself can already as well be a break even, where you don't need to cover that low. No, this can already be a break even after you just simply have an expansion phase candle. And that oftentimes is a good break even rule, where just a new expansion phase candle, not necessarily a fair value gap higher, can already be a break even as well. Where the 2 candle rejection, mixing it with order flow, be a little bit more careful with that as well, because it's a shame, honestly, to not capitalize on a clear higher time frame to then get lost in the lower time frame. What I mean by that is usually when we take a trade on the 5-minute right here, we're not actually taking a trade based on the 5-minute, right? We're taking a trade based on the higher time frame, because that was clear. The higher time frame draw liquidity was clear. So the lower time frame can mess around a little bit sometimes before it actually moves higher. So don't be too specific. There's a balance in that as well. All right, from risk management, we can now move on towards trading time right there. And for trading time, we need to go over right here, high probability versus low probability. So I want to get your mindset right as well. Generally speaking, there is more low probability conditions than high probability conditions. So for any trading plan, keep that in mind as well, that most likely you're going to be waiting more than actually doing something. Now, in that waiting and during that waiting, it's very important to limit your chart time. So the second thing here is chart time. Limit your chart time at all times. The more you stare at a chart, the more you're likely going to do something you shouldn't. And one is more susceptible than the other. For example, I personally am quite susceptible to staring at a chart and enforcing an ID that is simply not there. So what helps me a lot is setting alerts and avoiding a lot of chart time. Because usually when I open a chart and I see something extremely clear, that's exactly when I should trade. But if I stare at a chart for even an hour or longer, then I start to overthink, I start to force IDs that are not there. That's where most of my losses come from as well. So to avoid this, I use alerts. Use alerts to avoid a lot of chart time right there. So the way you can use alerts is at every stage of the trade. So what that means is right here, we need to wait for our narrative. So if we want to wait for our narrative, our boundary, our context area to be hit right here, then we can simply place an alert at this line right there. After we reach that line, then right here, we can go into the lower time frame to look for our entry. And when we start looking for our entry, what do we need based right here on an order flow entry? Well, we need an ST plus a RE. So what can we wait for? Simply 2 fair value gaps higher right there, ideally. So here, if we create this sharp turn, perfect. And we can even use an alert, something like an indicator right here, where you have FVGs and CEs plus alerts, simple and efficient method. If you use that by Twingel and you click on it, then of course you don't need to use the up and FVGs. You can all turn this off. Then right here, you can go towards the triple dot right there, the 3 dots to the more section, and you can actually add an alert. Now I'm currently in replay mode, and if I go to live mode right here, then I can add an alert at the top, and you can simply add an alert by condition, simple alert, down fair value gap confirmed, up fair value gap right there, confirmed as well. So when the fair value gap is actually confirmed, when we have those 3 candles. So right here, this is what we can then create, and then that will create an alert whenever a fair value gap is created on that particular time frame as well. Now, what we can also do, and what I personally like to do, is when we have that ST, for example, right there, I like to place an alert above this high right here. Because I know, ideally, I want to see fair value gap, and when a fair value gap is most likely going to get created, I get an alert when we trade above that high. So when we trade back above that high, we most likely have a fair value gap being created as well, which I want to enter off of. That's usually how I use alerts as well for order flow, where I expect fair value gaps to be created. If you don't want to wait for that expectation, potentially, which is oftentimes a lot more subjective, then what you can do is again use that indicator and use that alert when a fair value gap is being created. Now, for 2 candle rejection, what you can do is simple on the same time frame, set your alert for whenever that candle is going to close. So right here, I set my alert at 1 p.m. New York local time, because then that candle closes, perfect, I can potentially look at an entry. Same for the 1 hour. If I were to enter off the 1 hour candle rejection right there, okay, I set an alert when that 1 hour candle closes. So that limits my chart time a lot. And then I carry that over to break even as well, when I want to go break even. Now, oftentimes when I'm in a trade, I get more chart time. So I have the least chart time actually before I enter the trade. But when I enter the trade and when I'm in a trade, as general rule of thumb, my chart time is a little bit more, because I want to actively manage my risk as well and go and break even right there. But if you find yourself micromanaging a trade, so you find yourself oftentimes going break even too early, then ask yourselves, are your break even rules set in stone as well? And as well ask yourself, how much chart time do you actually have? Very important. Then next to the chart time, we have trading days right there. So as a general rule of thumb, Monday and Friday are low probability. Now, oftentimes it really depends on what kind of news, economic calendar news week we have. For example, if let's say Tuesday and Wednesday we have CPI and FOMC, then the volatility for the week will most likely be on a Friday as well. So at the end of the week. So that's when Friday is perfectly fine tradable. For this particular week, we had on Monday as well, a lot of volatility coming into the market on Monday. So that also means that Monday is quite tradable and high probability. But as a general rule of thumb, Monday and Friday are quite low probability days. Not necessarily always because of the trading conditions, but also because of psychology. Where Monday people tend to rush into the market and tend to lose money, tend to trade a lot, and then set themselves up for failure for the rest of the week. If you're trading on Monday, take it easy. Maybe decrease your risk even a little bit, because Mondays are there to get your confidence going. If you take a small win on Monday, perfect. You are starting that week off very good actually, and you get some confidence going into the remainder of that week. But if your Monday starts off bad, then you are setting yourself up for failure for the rest of the week. Now, if let's say you don't have any opportunity and Friday comes around the corner, and throughout the whole week you did not trade anything, so you did not see any opportunity, and Friday is not necessarily super high probability regarding volatility, time, price as well. So then Friday, do you want to make all your profits on a Friday? Generally speaking, no. If you haven't made any profits and Friday comes around the corner and Friday is actually there and you are looking to trade that Friday, I would advise simply avoid it. It's making the profits at the end of the week is usually not a good sign, because if there was no clear opportunity throughout the remainder of the week, then usually what's the case is that you're forcing an ID on Friday in already low probability conditions. So my advice would be avoid Friday as well in that scenario. If you're just starting out, as a general rule of thumb as well, again, it could be advised, and my advice would also be focus on Tuesday, Wednesday, and Thursday mainly for your trading right there. Now, what I want to add as well towards the trading time, which is not on this PowerPoint, is focus on one trade a day when you are just starting out. Focus on one trade a day, no more, no less. Well, of course, less if there's no opportunity, perfectly fine, close your chart. But if there's an opportunity, focus on one trade a day only. Then after that, we see, of course, the practice slide, where write down the risk management rules for yourself. So again, the 5% boundaries, if you do want to use that, then write it down for yourself. And the reason why is because then you also know how it works for yourself. So you don't get confused later on when you do want to start using it. So if you write it down, then most likely you will also understand it yourself. And then now we are ready to also go into the trading plans. Perfect. Thank you.